This is the last of the four-part series about price behavior, inflation, and deflation for Economics 53 in the spring of 2000. This one was a little late in coming because it's about policy, specifically about modern anti-inflation policy, and I suppose I should amend that to say modern anti-deflation policy as well, because the week that I'm giving this has been one of the most turbulent weeks in the history of the finance markets, maybe by some measures the most turbulent week in the history of the finance markets. So Federal Reserve efforts to try to calm things down is in full force right now. Although we're going to come back and cover the Federal Reserve System in the last 2 weeks of class, where we have 4 long lectures about that. I'm going to start talking about it now because we want to take the opportunity to see this in practice. The Federal Reserve is doing things right now that we need to talk about. And to some extent, their hands have been tied by their previous policy, I'm going to point out in this lecture. So I added quite a bit of that today, and it took quite a bit of time, but now I think we're ready to go. And this will be a little bit on the longer side because I have added this material to it. But I think you'll find it interesting. Now, here's kind of a summary of where we're going to go with this. When we talk specifically about traditional and historical anti-inflation policies, the policies are actually relatively simple. Monetary policy simply tightens up credit conditions and raises interest rates in the face of an emerging inflation. It is pretty much as simple as that. Now, how they do that with open market operations, we don't cover until we get to the last 2 weeks of the class, but we will come back to specifically their transmission mechanism and control mechanism that they use. I just put a note here. I don't want to talk about price controls because they generally don't work. They have been tried. They were tried in the Nixon administration. They have been tried overseas. They were tried back more distant in history. But for the largest part, they cause acute shortages of key commodities. They really encourage a substantial black market because people try to get around the controls. And then in the modern era, during the Nixon administration, it was found that they were easy to circumvent in a non-commodity economy with, quote, new product design. So if, for example, you put price controls on automobiles and you specify that a car can't rise in price, then the automobile manufacturers will come out with a new model and say, well, this is a different car, and its price is 15% more than the model we replaced. And so there's enough of that kind of brand level activity that price controls really don't work at all in the modern era. So we'll just talk about monetary policy. Now we'll begin by talking about kind of where it started for the modern era. And right now we're still using the loanable funds model to explain this. And I think we've seen this graph at least once before. And so this was the last Federal Reserve anti-inflation policy that has been used. And we tried to restore this policy to some extent in 2014, but that effectively failed. We'll talk about that when we get to it. Now, when we get back to 2004, 2005, and 2006, at the time, prices were just beginning to rise because of the recovery from the 2003 bottom of the recession that started in 2000. And the Federal Reserve System began to tighten slowly, starting in 2004, at the same time that consumer borrowing was continuing to grow slowly because the economy was recovering from a recession, but the economy was picking up steam reasonably fast. And as a consequence, interest rates were increased some between 2004 and 2006, and perhaps excessively so. So I figured I needed to be a little more specific about what I meant when I said they increased interest rates through using open market operations, which I will explain at some point. The previous graph was maybe just a little too general for you to understand this well. So I decided this year to add this graph. This graph you would see later, and we'll see again later in the class. But I think right now, I think you need to understand what I'm talking about. The Federal Reserve System has a target interest rate called the federal funds rate. And the federal funds rate, I won't explain very much right now because you need to sort of technically see how this system works to understand exactly what this interest rate is. So for the moment, I'll say it is the rate at which the Federal Reserve System makes loans to its member banks. That's pretty close to accurate. So if you're a bank, you can borrow from the Federal Reserve System, and the rate at which you would borrow is the federal funds rate. It turns out that these funds can also be loaned between banks, and that's actually more of the issue. They can lend reserves to each other at the federal funds rate, and they don't make very much money on that, but they can make some. Okay, so these interest rates are set by target. They are set by decree, and then the federal funds tries to enforce market mechanisms that will keep it in the range. Now, what I'm showing you here is the upper limit of the range as it has been established by declaration by the Federal Reserve System in their open market committee meetings when they meet about once a month. They meet 13 times a year or so, so it's a little more frequent than once a month. Now, when I say it's the upper limit of a range, the range is always 25 basis points. So I could have drawn a second little, say, blue curve or something like that that would have been just 25 basis points underneath the curve you're looking at here, but it wouldn't have looked very good, so I didn't do it. So when we say, for example, down here in this period between 2009 and 2015, if you look at this where you see it's very flat and low, then the upper range was 25 basis points, 0.25%, and the bottom of the range was actually 0.00%. So all of this mapping has that range, and this is the upper limit of that range. All right, well, in the year 2000, the Federal Reserve System was increasing these rates considerably because I think they were trying to curb stock market speculation back then. And as you can see, the federal funds rate went to 6.5%. Then beginning in March of 2000, we had the horrific dot-com crash where the market came tumbling down. The Fed knew that was serious. The economy instantly reacted to it and began to turn south, and we had a significant recession. So they realized they had interest rates too high. And as you can see here, they brought this target rate down very, very quickly. The target rate is reduced in one of the monthly meetings. And in between those meetings, it stays the same. And of course, for many meetings in a row, as you can see, between 2009 and 2015, it also stays the same. So the Federal Reserve brought this down really, really fast, as you can see. It was below 2% by 2002. It was at 1% by 2003. The recession bottomed out in 2003, partly because of this. It wasn't just that interest rates were coming down. As we saw on the previous slide for the loanable funds model, that implied that this is when they were tightening between 2004 and 2006. That implied that the Federal Reserve System, in contrast to what's being shown here, was increasing the supply of funds as opposed to tightening up. And so, of course, it would reverse the effect of what you're looking at here. Interest rates would be going down. So this would be an instance of where they were increasing the supply of funds in addition to dropping down the rate. So the dual combination in 2003 or so of the rapidly declining interest rates and the surge of credit turned the economy around, and we took off on an expansion again. But as your parents might remind you, that expansion resulted in an absolutely staggering real estate speculation where real estate prices just went absolutely through the roof. And that was the era when banks and other lenders were making really bad loans with very relaxed lending standards. It was a situation that was completely out of control. And the Federal Reserve System realized as early as 2005, 2006, what I just showed you, that real estate speculation was already underway and pretty rampant. And so they felt that they had to slow things down because the real estate component of the general inflation index has a fairly heavy weight, about 0.2 or so, depending on whether you're talking about the rental or the buying. And but also the speculation itself was perceived to be harmful. So the graph, again, that we looked at just previously, this one right here, the 2004 to 2006 tightening, is in reference to this period where it says real estate speculation rampant. That's when they were tightening. And they continued to tighten, as you can see, until 2006, when this target rate was 5.25. And so generally interest rates were fairly high at that time, although this rate was above some short-term Treasury rates and the like. Then, of course, as you know, in 2007 and certainly 2008, all of a sudden we have another meltdown. This time it's the mortgage meltdown, but that was also accompanied with a horrific stock market crash. And as they had done before in reaction to the dot-com market crash, down come interest rates really, really fast again. And by quite a stretch too. So by the time we get to 2009, which is only about 18 months after the peak at 5.25, we are at a 25 basis point upper limit on this rate, and the bottom of the range that this interest rate is supposed to be in is 0.00. And that stays in place for years because this economy needed this infusion of cash consistently to recover from all of the damage done by the mortgage meltdown. Then, as we're going to see here in a minute, in 2014, 2015, the Federal Reserve System said we need to start raising rates again. And as you can see, they started doing it between, well, let's see, this one looks like it's around 8 or 9, 2015. That first little pop up there. So we went from 0.25 to 0.5, and the bottom limit went to 0.25. And so then for a little while, then it popped back up again, and then the Fed was steadily raising rates every other month or so. In the last few years of Janet Yellen's tenure, that vertical blue line there is the time when Jerome Powell became chair of the Board of Governors. Janet Yellen was before him, so she initiated these rise in rates, or she actually worked with a committee that she chaired. The committee initiated the rise in rates. And so when Jerome Powell became chair in February 2018, he continued the practice, but it was beginning to it actually had a bit of a negative effect upon the stock market in 2018. That was a bad year for the market, and it was being soundly criticized, as we're going to see, by, at the time, President Trump, after Jerome Powell was appointed chair. And so at some point, they again reversed and brought interest rates back down. And just a few days ago, they once again dropped the federal funds target rate. They normally move it by 25 basis points at a time. This time they dropped it by 50 basis points, where the upper limit is 1.25 and the bottom limit is 1%. Now, one of the reasons why they were trying to raise rates in that last final little stair-step escalation is because, as we can see from this example, and as I've told you in this class before, this is the policy tool that the Federal Reserve System uses to get us out of bad recessions. They have used it twice on this graph. They brought down interest rates to respond to the market crash. They brought down interest rates to respond to the mortgage meltdown. And after many, many years of steady economic growth, fairly anemic at 2%, but still positive, Janet Yellen began to figure, well, we've got to get them back up again because there will be a recession someday, and we need this policy to respond. And for a while, Jerome Powell agreed with that. But as you can see, that has turned around. So let's talk a little bit about that. Now, you've heard me be somewhat critical of Jerome Powell. And so rather than me say it, let me read you what Wikipedia has to say about Jerome Powell. So I'll read this. On November 2nd, 2017, Trump nominated Powell to serve as chair. They approved him a little bit later, and Powell assumed office as chair on February the 5th, 2018. So that's the first day he had any power. So then, not long after that, Trump complained about the Fed raising rates, which, as we just saw, they were doing and had been doing under Janet Yellen. And in 2018, he said in an article with the Wall Street Journal that he maybe regretted nominating Powell, complaining that the Fed chairman almost looks like he's happy raising interest rates, which of course is ridiculous. They're raising interest rates for a reason. They're raising interest rates so they'll be high enough to bring them back down again in a recession. Powell has described the Fed's role as nonpartisan and apolitical, and that has always traditionally been their role. The Fed doesn't even get funding from the U.S. Treasury or the U.S. government. The Fed gets its funding from interest earned on the inventory of United States Treasury securities that they hold. So then in June 2019, Trump criticized Powell, saying, here's a guy nobody heard of him before, and now I made him, and he wants to show how tough he is. He's not doing a good job. Trump called the interest rate increase and the reduction of bond buying quantitative easing, which I'll explain in a moment, as insane. Well, it was not insane. It was actually good policy. In July 2019, when asked by the House Financial Services Committee, Maxine Waters, the chair, about the controversy, he said he would not stand down should President Trump attempt to remove him from his current post. He also stated that it is the Congress which has the authority for oversight of the central bank, and the board chair can only be removed for good cause, which is probably not true in this political climate now. Well, of course, I believe actually that the Federal Reserve System, and including Jerome Powell, actually did cave into this pressure, because the most recent downturns that we've seen, and I showed them just a minute ago, they peaked. Let's take a look at when they peaked. A couple of they peaked in right around January, right through the early months of 2019. So now it's been more than a year since they peaked. There has not been a threat of a recession since then. There has been some deflationary pressure in 2016 or so, but that was largely over at the time. And the only thing that the Federal Reserve System seems responsive to is stock market behavior. And in fact, this most recent reduction, just I think 3 or 4 days ago, when they dropped the federal funds rate by 50 basis points, that was clearly in reaction to the large drop in the stock market the few days before that. It was ironic, on the day in which they announced the drop in the federal funds rate, that ended up being a day when the Dow Jones Industrial Average at the close was down 1,200 points. The announcement by the Fed that they were dropping rates again had this time no effect on the market whatsoever. And a lot of analysts said because people realize the long-run implications of trying to respond to a market drop instead of responding to general economic conditions that you have to stimulate. So this most recent drop, I contend, is a very, very bad idea. It's not the job of the Federal Reserve System to save the stock market. Now, so you say, well, that's the federal funds rate. I don't even quite understand what it is, except I know it's kind of a short-term rate. But how do they affect the other interest rates? Well, for the largest part, it's mostly correlation. And these days, it's very poor correlation. The only rate they ever actually control is this federal funds rate. They have a lot of influence over short-term Treasury rates, as we'll see, because they control this by buying Treasury securities, mostly short-run. And they sort of hope, and kind of does happen, that general interest rates are supposed to follow the federal funds rate. When they drop the federal funds rates, then interest rates are supposed to follow with them. Now, whether they do or whether they don't is becoming kind of a big question. In recent months, in my opinion, it's the other way around now. The drop in the federal funds rate is actually responding to drops in market rates. The market rates have, I think, become almost entirely independent of what the Federal Reserve System official policy is, and that's unfortunate. Now, when we take a look at, this is monthly data too, if we were looking at monthly data for the federal funds rate, because of course it can change only once a month at the most, and we were looking at weekly or even daily data for the U.S. Treasury rate, it would be a little more revealing. You could see the lag structure and lead structure quite a bit better than you can see in this graph. Now you see, well, these interest rates came down, and the 10-year note rate came down as well, but on the other hand, you can see that the swings in the federal funds rates were substantial, like huge drop, big rise, huge drop, really flat, big rise, smaller rise, but still a relatively fast rise, and then a decline, whereas clearly the trend on the 10-year note rate is largely just down. Now, it is the case, looking at point 1, it is the case that that trough in the 10-year U.S. Treasury rate was hit at point 1. And you can see there that interest rate, and that was 2013, it looks like. Yeah, 2003. And you can see there that rates on the Treasury started to rise. Well, as you can see, that preceded by about 7 months the rise in the federal funds rate. So there's our first example that market rates were already rising faster than the federal funds rate. And then, of course, the federal funds rate shoots way up, and the 10-year note rate is higher, obviously, than it was at point 1, but in fact, it's considerably higher, 3.25 to about 5. But of course, it didn't rise proportionally, but you wouldn't expect it to rise proportionally. You have a swing here of almost 4% in the federal funds rate. You have a swing in the 10-year note rate of about 1.5%. Now, maybe that's okay. Anyway, when these rates are coming down, then we get to point 2, and of course, the federal funds rate flattens out, goes nowhere. As you can see, all during that period of time, although there was a great deal of volatility, the 10-year note rate continued to fall. And at point 3, then the federal funds rate starts to go up, and nonetheless, the 10-year note rate continues to fall for at least 6 months or so after the rate has been raised. Then finally you get a little compliance with the 10-year note rate. But at point 3, it's a little easier to see this if you're using weekly data. The 10-year note rate turns sharply down at a time when the Federal Reserve rate was actually rising, and continued sharply down when they didn't increase the federal funds rate, but they didn't decrease it. And you can see at point 3 that at the beginning of that little flat section, the 10-year note rate is about 1 full percentage point, 100 basis points above the federal funds rate. And when we get to the end to the flat section, the same 10-year note rate is about 150 basis points below the federal funds rate. So it's not having much an effect anymore on the federal funds rate. And of course, as we know, if you watch those videos I posted that were not mandatory but were optional about the stock market collapse last week, I pointed out that all of these rates have now gone to record low levels. And you can see now clearly that the 10-year note rate is below the federal funds rate, which happens to be true today. So there's a very loose correlation, and to me that indicates that the Federal Reserve System is more or less losing control over the general structure of interest rates, because the rates that are most tied to the federal fund rates are the Treasury rates, and this Treasury rate is not very well correlated. Okay, so let's continue on to go back a little bit now and talk about some of the programs that were used. Now, the quantitative easing programs from 2007 and 2014 are what I am describing as what pushed those rates down at the federal funds level. This was originally called TALF QE2, there was no QE1, quantitative easing 2, quantitative easing 3. They had various names. And back in these days that this was happening, I had told the students all the different names of the programs. The Federal Reserve System was buying, in its open market operations, Treasury securities and mortgages at an absolutely breakneck, unprecedented pace. As we just saw, they're severely cutting target interest rates to ease a credit crunch and prevent a serious recession. There was also very heavy fiscal policy at a time when there was a tendency toward private collapse, although that was over by about 2010, that was over with. So the private collapse part only happened for about the first 3 years of this. So this 2007 to 2014, going back to the previous graph, is, as you can see, let's go to the other graph, as you can see, this one's easier to read. This is when basically the Federal Reserve was just pumping money into the economy and keeping these interest rates at 0% or just above 0%. Although again, we can see that although the federal funds rate was at 0%, the Treasury rate, albeit low, was 1.5% to 3% or so over this time, but slowly declining. Now, finally, at the end of 2014, Janet Yellen announced what was a controversial policy. She said, we're going to taper off of QE3. We're going to stop this substantial credit expansion. And I represent this as a shift back in the supply of funds line because it actually was a slowdown in the very high growth rate to a lower growth rate. And so that's what I'm having to kind of represent, because when we get to a more developed model, when we get to the Federal Reserve System direct lectures on monetary policy at the end, we're going to say that if you actually slow down the positive growth rate of credit, it's reflected in these models actually as a shift backward in the supply of funds line. And that's because the demand for funds line is just constantly drifting out at about 2, 3, or 4%. So quantitative easing 3 purchased $45 billion of treasuries and $40 billion of mortgages every single month during the previous time period I talked about. So then they began to taper that back by $5 each month, and then another $5 billion each month, and continuing to do that. Then they said in 2015 they were going to slowly raise interest rates, but the stock market started to waver a little bit, and every time they sounded like they were going to raise interest rates, the stock market would turn down. And they thought, well, we want to trigger off a recession by causing the market to slip back down. In my opinion, they should have just said, to hell with the market, let the market do what it's going to do. Because if you keep the market going up for 10 years, when it finally corrects, it's like it's correcting right now. Absolutely wild and very dangerous. There's no reason to keep a market up for 7 or 8 years. So anyway, they were trying to taper, they were trying to bring interest rates down, and that carries into the present period when they basically started to try to raise rates again, and they gave up on it. Now, there was a problem that happened in between that I've already talked about, and that is we went through a period and have now apparently possibly returned to a period where we were starting to get close to nominal negative interest rates because of the central bank policy. So when the federal funds rate has a lower limit of 0%, it's pretty easy for certain classes of securities to dip below that and have a slightly negative yield. And this was starting to happen a little bit in the United States, but it was really starting to happen in Japan and in the European central bank market area, and especially in Germany, where even today I noticed the 10-year note rate in Germany is actually minus 0.85%. That's the lowest it's ever been. That's almost down 1%. That's starting to be something now. This means, though, that you can technically increase the supply of funds so much and drop interest rates so much that they actually start to move below zero. They become negative. Now, this is not going to be, if a bank account had this kind of deposit, or this interest rate, I should say, then the balance would actually go down in your savings account very, very slowly. This is more of a case of U.S. Treasury securities, investment-grade U.S. Treasury securities, very high-quality Treasury securities, actually having slightly negative yields because in times of trouble, people accept negative yields like right now. And we'll look at that for what's going on right now at the end of this lecture. So then you have a possible deflationary problem and negative interest rate problem, and we had that in 2016. There was some concern about that. Commodity prices often fall during this sort of scenario, so this is a little worrisome, and now it looks to me like it's back, maybe not for very long, but it's back. And because, of course, we can have deflationary expectations upon nominal interest rates that has the same effect as inflationary expectations, except it carries rates the other way. If I want to buy a new car And I honestly think that interest rates will not only fall but be negative. And also, if I think that the price of the car is going to decline, then aggregate demand for credit is going to go down. I'm not going to use credit until rates drop, or I'm just going to postpone credit, or I'm going to postpone credit until the coronavirus threat has passed or whatever. And so, of course, real estate and corporate borrowing can shrink in the face of that with the expectation that interest rates will go lower. And that, of course, really can take interest rates down to deflationary levels that are really unacceptable. And I think that's what's happening in Germany right now. So when we get to the present period, we've got the Federal Reserve System first increasing the supply of funds in 2017 and actually not really pursuing interest rate targets at all like they said they were going to do in 2017. And we had the strongest stock market in history as measured by the Sharpe ratio, if you know what that is, of the S&P 500. That was an absolutely non-volatile market that basically went straight up, about 25% in a single year. Then in 2019 and so in 2020, they're oscillating between increasing the supply of funds and decreasing the supply of funds. Now, with the drop in interest rates that they are engineering, they're once again increasing the supply of funds. So the 2019 line represents an increase in the supply of funds also for 2020. So the Federal Reserve has been equivocal on what it's actually trying to do since 2014. Sometimes they talk about raising rates, sometimes they talk about dropping rates. They're under pressure from the president. They're claiming they're not responding. I think they are responding, and is sowing confusion for the markets, and they're not supposed to be affecting the markets anyway. And therefore, when they drop them in the hope of curbing this market decline, the market on the day they did that fell at a very large rate. And it has since fallen just a couple of days ago. Yesterday, actually, given the day I recorded this, the Dow Jones fell 2,018 points. So so this keeps going back and forth. And the sad thing for me is that the Federal Reserve System is not prepared currently to be able to respond to a serious recession at this point, with interest rates at 0% before the recession. We go back and take a look at that slide. I don't think I need to show it to you again. This low interest rate was 6% before the dot-com crash and was 5.5% before the mortgage crash. If we are now ready for another recession, they're at essentially 0%, as I'm going to show you in the next slide. Now, you've seen two of these already, and if you saw the little ad hoc video I posted for both Econ 53 and Econ 136 students a couple of days ago, not required, I said it wasn't required, then you've seen the third one. Remember, you saw the top, it was on a different looking graph, it was yellow. But earlier, a few weeks ago, we had the 2019 graph, purple on the top, 29 April 2019. I commented, that's a flat yield curve. That's a bit unusual. That's a little worrisome. Then I showed you the 2020, Feb 20 yield curve, and it's even flatter and even lower. And I told you that I thought it was going to go down even lower. Well, the curve on 6 March 2020, and that's the one I put together to show students on the Friday before the big market crash, which was on Monday. The market had been down a lot already, but not like that 2,000 point drop on 9 March. It had dropped even more, so the bottom, or the orange line there, is what was relevant for this period. And I said in that video that I was almost certain that the entire structure was going to drop on Monday another 25 basis points, and that's exactly what it did. The green line on the very bottom, the 6 March was a Friday, so 7 and 8 were Saturday and Sunday. 9 March was a Monday, and Monday was at 2018 point. Wall Street Journal drop, as it says, 2013.76. The Treasury yield curve did not have a single asset above 1%. That's it on the very bottom. Even 30-year bonds were at 0.98%. Well, now what's the Federal Reserve going to do if we get into a recession with the entire spectrum of interest rates, including 30-year bonds, on investment-grade blue-chip assets yielding less than 1%? This is what I regard as what I think history will regard as a significant policy mistake. And so the reason I sort of wove it into this lecture is because it's topical. This is going on right in front of us now. Now, today is March the 10th, and today there's been a bit of a recovery from this. The market went up 1,000 points today, and this is what we're seeing. 1,000-point swings up and down. Boy, that is unprecedented. So it usually goes down a little bit, then pops up. It doesn't go up 1,000, down 1,000, up 1,000, down 2,000, up 1,000. It doesn't tend to do that. And of course, rates came up a little bit, but not very much. They're not above the orange line, and some of them are still below the orange line, actually. So that's Fed policy in a nutshell right now, and kind of a background on it and where we're going to go on it. We're going to return to this and take a look at the mechanics of open market operations long after the spring break, and you'll understand this quite a bit better. This is kind of a prep, and I made it a little longer and more complicated because it's unfolding before our very eyes just at the time I'm delivering this lecture. Okay, that's it for this, and I'll let you go. That's the end of this series too. So next is unemployment, and I've slowed those down too because that situation has come up right now, and that's a little atypical and unusual, so I've got to actually enhance that lecture a little bit as well. So that one is also going to be divided into 3 or 4 lectures. I think these shorter lectures are better. I think you tend to like them better. I'm not sure. I have to do a survey and find out. Anyway, on to unemployment.